Welcome everyone. My name is Timothy once again. I'm glad to take you through the Forex Masters webinar. I believe so far so good. You're doing great, right? Today I basically want to focus more in terms of psychology, the psychology perspective. Remember, Forex trading is 90%. People say that it is 60% psychology, but I usually say it is 90% psychology, because you understand, despite having the knowledge, knowing how to analyze charts, how to read the patterns and everything, if you miss it in terms of psychology, it becomes really difficult for you to maneuver or for you to get an edge in Forex trading, okay? And the reason why you see that most traders fail because of the aspect of psychology, okay? So I want us to take a big part of today's class to discuss about the trading psychology, how we can be able to improve our trading psychology so that we can align ourselves in the line of success when it comes to Forex trading, okay? And before we delve into what you're supposed to look at, I would want us basically, first of all, we look at just to mention a few things that with Scope Market at the moment, we have bonuses. We have various bonuses that we're giving to our clients, and even those that are aspiring to join us. For the first time deposit, the client who has opened an account and is making the first time deposit, you get a 50% bonus for every for a minimum of $100 that you deposit, okay? So for existing clients, any deposit you make, you can get 100% bonus if you deposit $500 and above. And for those that are joining us for the first time coming, maybe you are trading with another broker and you want to trade with Scope Markets, you get what we call switcher bonus, 100% for a minimum of $200 that you deposit, okay? So these bonuses are redeemable. Again, they help you to increase your leverage, okay? To increase your margin. So they can help you in terms of increasing your margin level, okay? So and the more you trade, the more you're able to redeem these bonuses. By every 0.25 lot you trade, you earn $1, which is credited to your account, okay? So take advantage of these bonuses, and they will help you in terms of boosting your margin and also your capital as well, right? So that being said, let's get into the business of the day. And I will start from the beginning, but I'll just be brushing through. But I want to have more time so that we can talk about the risk management, okay, or the psychology of Forex trading, okay. Remember, we have recordings of the previous class. I've been teaching the same. These are the same slides that I've been using to teach. So you can always contact your account manager, and he or she will share the recording with you, okay? So in this master's class, I usually talk about the technical indicators, especially those that want to use use indicators to trade, okay? Personally, I am a price action trader. That is, I don't use indicators, okay? But that does not mean that indicators are bad, okay? The only thing with indicators, the difference between the person who uses an indicator and the person who uses price action is that the person who uses price action is able to get high probability setups or is able to get early entries compared to the person using indicators. The reason why is because these indicators, they are lagging span, okay? They are lagging span. By lagging span, I mean they follow the price. So the price has to react so that the indicators can follow what the price is doing, okay? So you find if you're using the indicators, you might get these entries, good entries, but not as early as the person who uses what? Who uses price action, pure price action. Okay, so when we talk about technical indicators, basically we have a couple of them, many of them actually, some and many of these are free in the MT5. Okay, but there are some which are custom made. Okay, you know that there are people who create indicators and sell them. So they sell them and they install in your MT5 or whatever platform that you are using. Okay, so so there are many of them, and just like I've listed here, these are just but a few: the moving average, the stochastic oscillator, the relative strength index, and we have the MACD, the Bollinger Bands, the parabolic SAL. Okay, but for the purpose of this class, I want us to, we shall basically have an overview of the moving averages. Okay, so the moving averages, and when you have the moving averages, basically the work of the moving average is to help you identify the trend. Okay, it's to help you identify the trend. And when you are using the moving average, the best combination is the 50 moving average, 100 simple moving average, and 200 simple moving average. That is SMA, simple moving average. Okay, so when you have this combination, like you can see in my chart, these will help you in terms, especially the higher moving average will help you in terms of direction. Okay, it will help you in terms of direction, or to know the trend of the market. Then these other ones will help, especially a combination of the three of them will help you now to identify change of trend. Okay, to identify change of trend. So basically with the MA, with the moving averages, we trade them in two ways. Okay, we trade them with two ways. One, you can be able to trade the bounce, like we trade the support and resistance, the bounce, and also the breakout. Okay, the bounce and the breakout, the bounce and the breakout. So how do you trade the bounce? Okay, like you can see in my chart here, the 200, the yellow one is the 200 moving average. Okay, so this one shows the trend. So it's showing you right now around this area, this is an uptrend, right? So in an uptrend, then you want to position yourself as a buyer. Remember, the second rule in Forex trading is that the trend is your friend. Okay, the first rule is about proper risk management. Okay, so risk management is the strategy of all strategies. Okay, and that is the rule number one, that you always do not risk more than 1 to 3% of your capital per trade. Okay, we are getting there, so we shall discuss more about that. But with this, the yellow one is acting as support. Okay, you can see it's acting as support. So the price bounces off, then it reaches this area, then it bounces off again it comes to that area and bounces off. So it's acting like a trend line. Okay, an uptrend trend line, right? So it's supporting the prices from going below down, right? Then we have this side. Once we have the breakout, okay, once we have the breakout, this is the breakout. Okay, so we have the breakout and now the direction changes. Okay, the direction changes. Now this is a sell market. Okay, so how do you trade the bounce? Okay, so the bounce, once we have this breakout here, also we had a breakout. Okay, so the market came at this level, and once you identify the rejection patterns, you see the price rejecting from that level, then that is the bounce. So you want to buy from these areas. You want to buy from these areas because it's an uptrend. So you only want to be looking for your buy entries. Okay, you want to be looking for your buy entries. Okay, so that is the bounce. Then the breakout, when we have the breakout happening at this point, so after every breakout, remember the rule of thumb, after every breakout, you wait for a retest. That needs to sink. That needs to sink in your mind, that after every breakout, there must be a retest. So don't trade without waiting for a retest. And like you can see, the price came to this area once, twice, okay, before dropping. Okay, so this is now the retest. The breakout happened here and the retest is happening here. So once you see the rejection of prices, now you anticipate the price to do what? To go down, and you look for your sell entries at that level. Okay, so that is the breakout, right? Also, you can be able to when identifying the change of trend, we use the crossover. Okay, we use the crossover of the moving averages. The reason we are combining the three of them, okay, and especially the crossover of the 100 and 200 moving average, these will always give you an indication that the market is changing direction. Okay, that the market is changing direction. So in this example here, you can see the crossover. You can see the crossing over of the moving averages. Okay, so you can see the crossing over. You can see the crossover. So this indicates that now we are no longer in an uptrend, but now we are in a downtrend. Okay, and you can see the point where the crossover is happening. The reason why I said the indicators are lagging span. For a person who uses price action, you could have gotten this entry at this level, okay, at that level. But for the person who uses indicator, you have to wait. You have to wait until the crossover happens, so that you can know now we have a change in direction. Okay, we have a change in direction, right? Also, if you're using pure price action, a person who is using pure price action, you could have identified that this area again, we had the change in structure. Okay, we had the change in structure. The market is trying to change from the uptrend, now looking to the downtrend. Okay, that is what we covered yesterday. Okay, what we covered, I think I taught this yesterday, how to identify a change in market structure when we have an uptrend. Okay, when you have an uptrend, then all of a sudden we have this movement. Okay, so you look at the previous high low of the uptrend and you draw a line at that point. So when the market comes and breaks through that the previous high low, then and closes below that level, then we have a change in market structure, and you'll be waiting for the market to come back to retest that area, so that now we can start selling the market. Okay, so these you can identify here using the pure price action. But for the indicators, especially the moving average, you had to wait for some time until the moving average cross each other. So the reason why I'm saying they are lagging span, but I'm not saying they are bad. There are those who use indicators and are very profitable. Okay, so probably at this point, maybe you don't know which is best for you. So that means you can use whichever. You can be testing the indicators as well as you test the price action. Okay, so you see which one gives you an edge. Okay, so again, these moving averages will help you identify the exits point and entry points. Okay, so for instance, if you are in a buy here, once when these moving averages crossed over, okay, so you entered a buy. So once they cross over again at this level, then it means it's time to exit the market, because now you are looking to change the direction. Okay, you are looking to change the direction, right? So I said don't take so much on this, because there is a point I want us to look at, especially in terms of risk management, because I know psychology, because that is where that is the elephant in the room. Okay, so this is the relative strength index, meaning of price action and examples. Please attend the beginners class. You can attend the beginners class. We have I've talked about not the beginners class. In yesterday's class, you are in yesterday's class. Adan, you are in yesterday's class. I remember you asking questions, and we began with looking at what is price action. Okay, so please revisit. You can ask your account manager to send you the link kindly, and revisit what we discussed yesterday. Basically, price action is the movement of price over time. Okay, so the way the price moves over time, that is price action. And when we are studying price action, that is basically the technical analysis. So technical analysis is the study of price action, previous price action, so as to anticipate the future movement. Okay, during breakout, do we have to wait for more than one retest? Basically, at times the market will give you one retest, another time it will give even 2 or 3. For me, how I do it is the first retest, because even if it does the second and the third retest, it will be still in the same region. Okay, it will be still in the same region. So the first retest for me, it's good. Once I see the rejection, then I am in the trade. Okay, I am in the trade. So let's move on. So the relative strength index, this is an oscillator. It is an oscillator. So basically, it will help you identify the areas of overbought and the areas of oversold. Okay. So when we have the relative strength index, it basically moves within the areas. It has a range of 0 to 100. Okay, 0 to 100. But for us, you are interested with 0 to 30. And 70 to 100. Okay, 70 to 100. So 0 to 30 basically means the market is oversold. Okay, so if the market is oversold, then we shall be looking to buy. 70 to 100 means that the market is overbought. So if the market is overbought, then basically it means we shall be looking to sell. So this gives us an indication to start looking for sells, and these levels give us an indication to start looking for buys. Okay, so like you can see in these levels, so this is the 0 to 30. So once the RSI is in these levels, it means that the market is oversold. 70 to 100, that level, it means that the market is overbought. Okay, so it is in these levels that we look to sell, and it is in this level that we look to buy. Okay, so catch my words accordingly. I'm saying we look to sell and we look to buy, because again, we don't always sell and buy in these levels, but you want to align yourself with the trend. For instance, if this is a downtrend, right? So we said the trend is your friend. So in a downtrend, then you only want to be selling. Okay, so you want these instances when the RSI is at the 70 to 100 levels. Okay, these instances, and now you sell the market. Okay, you sell the market, and you can see the respected. Okay, so in an uptrend, then you want to be buying only because the trend is your friend. So it is at these levels when the market is in the areas of oversold that now you want to buy the market. So in an uptrend, you want to be buying only. In a downtrend, you want to be selling only. Okay, so don't confuse yourself and start buying and selling aimlessly or anyhowly without aligning yourself with the trend, because that will not be a high probability trade, and these indicators might not work out the best for you. Okay, they might not work out the best for you. We said if you want to establish a trend line, if you want to establish the trend, you can use the moving averages. Okay, you can use the moving averages. The moving averages, they always show you the trend, so that you can now know what is the trend, so that you can align yourself whether you're buying or selling depending on the trend. Okay, so we have an improvised mode of RSI, which is the stochastic oscillator, and the stochastic oscillator as well, it's a modified I call it a modified RSI. Okay, a modified RSI, because again it shows the areas of overbought and oversold. Okay, so it ranges from 0 to 100 as well, 0 to 100, but when the market is between 0 to 20, these are the levels of oversold. So when the market is oversold, then we shall be looking to buy. Okay, and when the market is when the oscillator is between 80 to 100, then these are areas of overbought. Okay, so when the market is overbought, then we shall be looking to sell. Okay, we shall be looking to sell, right? So basically the stochastic oscillator, this is how it looks in the chart. So it comes with an additional feature that it has two lines. It has two moving averages with it. Okay, it has two moving averages with it, as you can see. So if this is an uptrend, then we want to see when the market is between 80 to 100. I mean, when the market is between 0 to 20, because we always buy in an uptrend, okay? We always buy in an uptrend. So these instances, okay, these scenarios, they are the ones we want to see so that we can engage in the market, okay? So that we can engage the buying mood, because we're in an uptrend, right? We have already identified the trend, it's an uptrend. So you want to look at areas when the market is oversold so that you can buy. And this comes, I said, it's a modified version of the stock of the RSI, and the two lines will help you in terms of when they cross each other, okay? When they cross each other and point upwards, it gives you another second confirmation. Remember, with the indicators, the caution is that do not rely only on one indicator. Use at least 2 or 3 indicators so that you can have a high probability entry or trade setup, okay? And number 2, always ensure that you can give at least 2 or 3, at least 2 reasons why you are buying and selling, okay? So when you are using this, this gives you another a +1 bonus or +1 reason why you should probably buy the market at this point, because the moving averages of the stochastic oscillator, they have crossed each other and pointed upwards, okay? So that's an extra confirmation or a +1 bonus confirmation, okay? So when the market is trending downwards in the downtrend, then you want to look at instances of what? Instances when the market is overbought, so that we can sell, because it's a downtrend, okay? Because it's a downtrend. So we want to look at those instances when the market is overbought so that you can look to sell, okay? And before you sell, you have to see that the stochastic oscillator moving averages in the stochastic oscillator, they cross each other and point downwards, okay? Meaning that now the selling mood is in place, or the downtrend is now confirmed, and now you should start looking for your sell entries, okay? You should start looking for your sell entries, right? So that is the stochastic oscillator. And then now we shall brush through the fundamental analysis, but this we shall iron again tomorrow when you're doing. I think tomorrow we shall have a live NFP trading. At the same time, we shall be doing the Machakos event. So we have a Machakos mentorship tomorrow. Okay, so if you're around Machakos, we will share, the details will be shared in our Telegram group, the location and everything, and you can get the same information from your account manager. So when you're talking about fundamentals, these are the economic events that happen during in the market, okay? They can be not only economic events, but they can be economic events, political and social events, okay? That causes or affects the supply and demand, okay? That causes or affects the supply and demand of a security, okay? So the demand and supply affects the value of a currency, okay? So when we have high demand, the price of that currency appreciates. When we have high supply, the value of that currency depreciates, okay? So also, we have consumer spending, which also affects the money supply. So if consumers are not spending, then it means that there is no money supply. But when consumers are spending, then it means there is money supply. And also it creates a notion that there is the consumer confident, okay? Because you cannot spend when you're not confident with the economy, okay? Or again, you cannot spend when you are not employed, okay? So all these trickles all moves around each other, and what I want to teach you today, or what I want you to understand, is how to be able to interpret these economic data, or these whether economic, political, or social, how to align yourself in the market so that you can get entries, okay? Like tonight, yesterday we had the FOMC, okay? We had the FOMC. So when you're talking about fundamental analysis, these are some of the economic activities or events that are listed in the economic calendar. Okay, we have different types of economic calendar. There are those that use Forex Factory, like myself. There are those that use investing.com. They also have an economic calendar where they update you with the events that are about to happen. Okay, they update you with the events that are about to happen so that you can align yourself accordingly. What is on my screen are some of the examples of the economic events that we have. But basically, I want us to look at the three main ones, which are the interest rates, the inflation, and the employment. Those are the three main economic events that really move the market. Okay, so when we talk about the interest rates, you need to understand that these interest rates, it's what banks, or it's what used by the banks to curb inflation. Okay, so when we have high inflation, the interest rates, the banks, the central bank will tend to increase the interest rates so as to lower inflation. Okay, and when we have low inflation, then the central banks will tend to lower the interest rates so as to maintain inflation to its normal standard. Okay, one thing that you need to know, then an anticipation in the interest rate hike by the central bank will make the currency value to appreciate. Okay, like what we saw yesterday for the FOMC, they retained the interest rates to be 5.0. There was no increase, there was no decrease. Okay, it remained the same. And the reason why you saw, if you follow the FOMC yesterday, the price went up, went down, and went up again. Okay, because there was no change. So it reacted on both sides. So we had no directional bias. Basically, it was like a range, because it went up, it went down, and up, and now it's trying to gain back to its normal direction. Okay, so especially those that follow gold, that's what happened, right? Because there was no change. It was just the same like the previous month. That is 5.50. Okay, so an anticipated interest rate fall leads to currency depreciation. So if we have a decrease in interest rates, then this affects the currency in terms of depreciation. The currency of that country depreciates in value. Okay, so that's how you are able to align yourself. Let's say, just giving a scenario, let's assume yesterday the Fed rate moved from 5.50 to maybe 5.6. Okay, so this means that the interest rates have increased. Okay, just giving an example, this means that the interest rates have increased. So if the interest rates have increased, then we are saying that an anticipated interest rate hike by the central bank will make the current currency's value to appreciate. Okay, so this is for the USD. You're assuming that this is the FOMC. Okay, so if the interest rate increases, then it means that the USD is going to increase in value. Okay, so if the USD is going to increase in value, then you want to have to align yourself accordingly. The rule of thumb is, when the base currency, we talked about the base currency and the quote currency. Okay, so when the base currency is stronger than the quote currency, then this gives you an indication to do what? To buy, right? And when the quote currency is stronger than the base currency, then this is an indication of what? A sell. Okay, always this is the rule of thumb when you're trading fundamentals. This is how you align yourself. So in this example, USD gains strength because there is an increase in the interest rates. So USD gains strength. So for someone who trades GBP USD, then it means this is how you want to do for GBP USD. It means that it could give a sell because the quote currency, which is USD, is greater than or has more strength than the base currency, which is GBP. So you look to sell. For someone who trades maybe gold, okay, gold is just the same thing, okay, because USD is the quote currency here. So the quote currency greater than the base currency or stronger than the base currency, we sell. Okay, for someone who trades maybe USD JPY, here USD is a quote currency. It's a base currency, right? So when the base currency is stronger than the quote currency, we buy. So for someone who is trading USD JPY, you'll be looking to do what? You'll be looking to buy the market. Okay, you'll be looking to buy the market. You'll be looking to buy the market. So we move on to the inflation. Okay, we move on to the inflation. Again, how you align yourself is the rule of thumb. When the base currency is greater than the quote currency, we buy. When the quote currency is greater or stronger than the base currency, we look to sell. Right? That is the rule of thumb. So that is what you need to do after you interpret the data. And the reason why we usually wait for the data to be released so that we can know which currency has gained depending on the data, and then we align ourselves in the market accordingly. Anytime you find yourself trading news or trading fundamentals without the data first, then you're not trading, but you're trying to chase the price. Okay, you're trying to chase the price. Smart traders wait for the data first. You interpret the data, and then now you start looking for your entry positions. You start looking for your entry positions. So when you talk about inflation, you know that inflation is a steady increase in prices of services and goods. Okay, of services and goods. Like right now, the inflation rate is high. Okay, the October inflation rate for Kenya is was released, and it's 6.9. It was 6.9%. Okay, so the inflation rate is still high. So the inflation rate is measured by what we call CPI. That is the Consumer Price Index. So in the Forex factory or in the economic calendar, when you see the CPI, basically know that this is the inflation data. Okay, so there is a moderate inflation that it's supposed to be for especially the developed economies. So this is the moderate inflation. When we have between 1 to 2%, that is moderate inflation. But when the inflation is above 3 to 4%, then that is an overwhelming economy. Okay, overwhelming economy or overheating economy. So inflation above the market expectation causes the currency to strengthen, because we said when the inflation is high, the central bank will increase the interest rates, and we have seen an increase in the interest rates will cause the currency to do what? To appreciate. And the reason why we are saying that inflation above the market expectation causes the currency to strengthen in anticipation for hikes in interest rates. Okay, so if inflation rate falls short of the expectation, we anticipate the rates to be reduced. Let me give an example. We have the CPI data. Just an example. Let's say the CPI data, the previous maybe was 4.0, and the current, now that the data has been released, it's around, let's say 3.0. Okay, so what does this give you? This gives you an indication that there is a reduction in inflation. Okay, there is a reduction in inflation. Let's say that this was the US inflation data, so it will affect the USD. So what does this mean? A decrease in inflation. Okay, a decrease in inflation. So when there is a decrease in inflation, then the interest rates, the banks will tend to lower the interest rates in anticipation of trying to keep the inflation at par. Okay, so when the interest rates decline, then it means the currency will lose value. Okay, the currency will lose value. So when the CPI decreases from 4.0 to 3.0, then the USD will lose value. Okay, it will lose value. So if again you trade like GBP USD, then in this pair you want to buy, because USD has less value or weakens compared to GBP. Okay, when you are doing something like USD JPY, then here you want to sell, because USD is weaker compared to JPY. Okay, so basically that's how you align yourself. You wait for the data, you interpret the data, and then you position yourself accordingly. The other thing, or the other A very important economic event or data is the employment outlook. And this is the NFP, what we have tomorrow. Okay, what we have tomorrow, the NFP. So with employment outlook, how you look at things, we are always concerned with the hourly wage, the change in hourly wage, and also the unemployment rate. Okay, so when we have high unemployment rate, what does that tell you? It indicates that there are many people who are jobless. Okay, there are many people who are jobless. So if we have so many people who are jobless, then it means that the economy is affected negatively because people are not spending since they don't have money. They're not making money because they are jobless, right? So when you find, let's say, for instance, the rate of unemployment increases maybe from 6.0 to, let's say, 7.0. Okay, so when there is a decrease, when there is an increase, this affects the currency negatively. Okay, it affects the economy, and that means the currency is affected negatively. If it is USD, we have an unemployment rate increasing from 6.0 to 7.0, then that means that the USD will weaken. Okay, so the USD will weaken. So now again, you look at the pairs that you trade. Where is the USD? Is it a base currency or is it a quote currency? And then now you are able to know whether you are going to buy or sell that currency. Okay, you know that whether you're going to buy and sell that currency. That's what we shall be looking at tomorrow as we anticipate the NFP, tomorrow at 3:30 p.m. Okay, at 3:30 p.m. So when you look at in the Forex Factory, you'll find that the previous average hourly earning was 0.2%. So they are projecting, or they are forecasting to increase to 0.3%. So when we have average hourly earning increase, it means that people are being paid well. Okay, there is like an increment in terms of salary, meaning that people can spend, right? And if people spend, then there is money supply, which affects the economy positively. Okay, so if this data comes out positive, like they are projecting, then this might strengthen the dollar. Also, that we have the non-farm employment change. Okay, so when we have the previous was 336K, right? And now they are projecting 179K. Okay, so that again, if it comes out like that, you find that it will affect the dollar positively. When we have the unemployment rate, the previous was 3.8%. Right now, they are projecting to remain the same. Okay, so if it remains the same, well and good. If it increases, then it means the dollar will be affected negatively. If it decreases, then it's even better because it will affect the dollar positively. Okay, so that's what we shall be trying to see tomorrow. Once we have the data, we shall talk about more during tomorrow's session, so that we can try to see whether we can have entries. Okay, so ensure again, as always, you attend these webinars with your live funded accounts, so that we when you get position, which you shall get tomorrow, you shall be trading live, so that you don't miss those opportunities. Okay, so let me look at some of your questions before I go to the next piece of information that I want us to cover. So between the RSI and the stochastic oscillator, which is more convenient? The stochastic oscillator is best, but again, you can combine both of them. You can use both RSI and the stochastic. Stochastic is much best because it has a second confirmation, the double lines that cross over and maybe point upwards to signify buy and point downwards to signify sell. Okay, so it's a modified or an improved version of RSI. How can one use Forex Factory in predicting the fundamentals? More of that tomorrow, but I've already tried to explain. I believe I've tried to explain. So you look at the previous data, because we always have three sections. The previous data and the forecasted data that is already available. So from there, you are able, it gives you a picture, a rough picture in mind, because this forecast is not just by individuals. This is the forecast that is done by banks, okay, like 12 banks, and then they do an average, top banks in that economy, and then they do an average, okay. So most of the time you'll find that the projection or the forecast tends to be the same. Okay, it tends to be the same like the actual data. When I say it tends to be the same, it does not mean that necessarily it will be like the exact figure that they have projected. So if they are saying, like, let's take for instance, right now they are projecting that they are forecasting that the average hourly earnings will increase from the previous, which was 0.2, to the to 0.3, which is the current forecast. Okay, so when the data comes out tomorrow, it might not be exactly the 0.3, but here what is they're trying to tell us that the hourly average earnings will increase. So if we have 4 as the actual, then this prediction was right, because the purpose of this prediction is whether to show us it will increase or it will decrease. Okay, so that's how we use it, so as we can have a rough idea. But now we have to wait for the data itself, the actual, so that we can align ourselves accordingly. Okay, so that we can align ourselves accordingly. RSI and are they similar or have difference? The volatility, the RSI and the volatility, they are not similar. Okay, the volatility is a tradable instrument. The RSI is an indicator, so they cannot be similar. They cannot be similar. They cannot be similar. Okay, so you have to know that for us, Scope Market or any other Kenyan broker, we don't do the volatility indexes. Okay, we are not regulated to do the volatility indexes because these are not regulated. Okay, they are not regulated instrument. The reason why we specify mainly on Forex and commodities and stocks, and those indices that are regulated, like the US 30 and the whatever. So the US 30, the S&P and 500, the NAS, okay, those are the ones that are regulated. But about the volatility 75, volatility whatever, those that are traded with deriv, they are not regulated in Kenya. We are not allowed to have them for our clients. And also the cryptocurrency, we are not allowed to have them for our clients because it's not yet regulated in Kenya. Okay, it is not regulated in Kenya. So when we talk about the chart patterns, this one I'll just brush through. And these are the various types of chart patterns. The reason why I want to brush through is because I want us to have enough time to discuss about the psychology of trading. Okay, the psychology of trading. So when we talk about the chart patterns, they can be categorized into 2: reversal chart patterns and continuation chart patterns. Okay, reversal chart patterns and continuation chart patterns. Okay, so when we have you know that, then what are the reversal chart patterns? These are chart patterns that will help you know when the market is reversing, maybe from an uptrend to a downtrend, or from a downtrend to an uptrend. When you talk about continuation patterns, okay, these are the ones that shows you maybe the market was in an uptrend, and then they will show you whether the market will continue in that uptrend. Okay, so they show continuation of a trend. Okay, so it can be continuation of an uptrend, it can be continuation of a downtrend, right? So under the reversal patterns, we have the head and shoulder, we have the double top and the double bottom, we can have the triple top and the triple bottom, the inverse, head and shoulder, the rising wedge and the falling wedge. Under continuation patterns, we can have the rising and the falling wedge, bullish and bearish rectangle, bullish and bearish peanuts. Okay, so those fall under the continuation or consolidation patterns. Okay, so I just did a picture here just to summarize these chart patterns. So this is the a double top. That's how it looks like. This is the head and shoulder. So this is the left shoulder, this is the right shoulder, and this is the head. The reason we call it the head and shoulder pattern. This is the rising wedge, the double bottom, the inverse head and shoulder, and the falling wedge. Okay, and the falling wedge. So in the previous recorded webinar, I discussed in details how to trade these patterns. What I want you to do, just message your account manager, and he or she will send you a recording that I did the previous recording for the Forex Masters class, and you will be able to see how I explained in details how to trade these chart patterns, or how to identify them and how to take trades using these chart patterns. Okay, then from there you'll be good to go. But in the next class, Forex Masters, I will again repeat the same. But for this lesson, I just want us to spare some time and do the trading psychology. And these are also the continuation patterns: the falling wedge, the bullish rectangle, the bullish peanuts, the rising wedge. All of them I have just done a summary in picture form to show you how to trade them, and how exactly do they look like, so that you can be able to identify them in the charts. Again, in the previous webinar, I discussed them in details, how to identify them and how to trade them. Okay, so ensure you ask for that link, and you'll be good to go, right? So now let's enter into the elephant in the room. I'll begin by saying that despite you knowing all the strategies that exist in the world, you can be knowing them all, you can be knowing how to make good entries, and you can know how to have nice exits, okay? But again, if you miss it in terms of risk management, which falls under the psychology of Forex trading, or under the psychology of trading, then you will end up struggling. I'm speaking this from the bottom of my heart, because this is one aspect that delayed my progress in Forex. It delayed me succeeding in Forex, because when I heard about Forex, I came with the mentality of making money. So when I had that mentality of making money, then what drove me, or what took part of basically what propelled me, was greed. So I needed to make a lot of money and in a short duration. So that is greed. When you want to make a lot of money and in a short duration. When you are not satisfied with the little that you are making and you want to make huge cash at a glance, that is greed. Okay. So it was until, because I was very good in identifying the chart patterns, the analysis, everything, I was good. But now, because of greed, so I find myself over leveraging, over trading, and chasing after losses. When I make losses, I chase after those losses, and that's what made me even to blow accounts, because I have blown accounts. I can't lie to you, I have not blown account, I have blown. But it is until I learned my mistake that I improved. From now, I stopped blowing accounts and now turned to be a successful trader. Okay, maybe you are in this webinar, or maybe you'll watch the recording later. But I want to tell you that without proper risk management, without the correct psychology, you will struggle in terms of Forex trading. Okay, so Forex risk management is a very crucial aspect of Forex trading that will help you protect your capital and minimize potential losses. Remember, for this, you want to be in this for long, for the longest duration possible. It's not just short term. Okay, so the key goal is how will you minimize your capital, and how will you protect your capital, and how will you minimize your losses? Why are we not saying eliminate losses? It's because in Forex trading, I want to tell you for sure, you cannot eliminate losses. Okay, losses will always be there. Like I've been telling you, there is no strategy that is 100% perfect. If there was that strategy that was that gives people 100% results all the time, then that is the strategy we could all be trading, and that is the strategy we could all be teaching. Okay, That being said, then what you want to have, or what we have, there are different strategies that have been backtested and have been found to have like 80% or 70% win rate. As long as it's 70% and above win rate, that is a strategy that you want maybe to capitalize in it and fine tune it so that it can give you higher wins. So you can move it from 70 maybe to 80 to 90% win rate, okay? And that being said, now the reason why, again, we are not talking about eliminating losses, but we are talking about minimizing losses, because there are those instances that the market will get you in the wrong direction. No matter how many years you've been in Forex trading, you'll still make a loss, 1 or 2 or 3, okay? So the key thing now is, how do we minimize these losses? How do we minimize potential losses? And this is where now the aspect of risk management comes into place. The rule of thumb in terms of risk management, the rule of thumb is don't risk more than 1 to 3% of your account per trade. So if you have an account balance of $1,000, don't risk more than 1 to 3% of that account. As a beginner, you can start with 1%. As you advance, you move to 2%. And then the final or the highest level you can have is 3%. But we tend to ignore these rules because we want to make a lot of money within a short duration, guys. And this is where we miss it. This is where we miss the mark. Okay? So always ensure that you trade, when you're trading, put this in place, have it in a writing, okay? If you have a trading room, stick it in a wall, or stick it in a sticker. There is a sticker that you can be able to stick in your laptop as you trade, as you analyze. Let it be there that you are always not going to risk more than 1 to 3% of your account. If you are seeing that sticker there, you'll tend to obey these rules, okay? If you disobey the rules and the sticker is there, then I don't know how you can look at things. But again, we can try to help you, okay? We can try to help you, because the key thing here is to be disciplined. You want to be a disciplined trader, okay? So that you can be successful, right? But again, you find that, I don't know, but when there is a person who said that rules are meant to be broken, okay? Rules are meant to be broken. So when you have rules, there are those who feel good when they break the rules. They don't want to follow the rules. They want to break the rules. But what happens when you break the rules? You find yourself in troubles, okay? Like for instance, if you break the rules of Kenya, if you go against some of the rules here in Kenya, you know them, you might find yourself in jail, live imprisonment, okay? Or maybe you spend a couple of years in jail. The same case in Forex. If you break the rules, you find yourself struggling for some time before you come to break even, or before you become successful. Or you might even not become successful at all. That is live imprisonment. You'll end up hating Forex. You'll end up saying that Forex is a scam. Yet it is not, okay? Yet it is not. So the rule of thumb is don't risk more than 1 to 3% of your account, right? So what are some of these risk management strategies that we are talking about? Number one is position sizing, okay? When you talk about position sizing, this is the lot size. This is the lot size. How do you choose the best lot size to use? And I will again, we shall be guided again by the rule of thumb. Don't risk more than 1 to 3% of your account, okay? Don't risk more than 3% of your trading capital per trade. So if you have a $1,000 account, probably you are risking even 3%, the highest, because I know you want to make a lot of money within a short duration. So you'll feel probably uncomfortable using 1% or 2%. So you'll tend to lean, majority tends to lean in the upper side, which is okay as long as it's within the limit. So 3% of 3,000. So that gives you what? $30, okay? So if you have an account of $1,000, you want to risk $30. So every position you are taking, you are risking $30. So if you are risking $30, why then should you be trading with a lot size of 1.0, that is a standard lot size, in a $1,000 account? It doesn't make sense, because with every minus 10 pips movement with a standard lot size, it gives you minus $100, right? So if these trades happen to go 100 pips in loss, then the whole account is gone. Or if you happen to make, like, let's say 10 consecutive losses, or 5, depending with the with your risk, then all this account is blown. Okay, so if you identify that you're supposed to risk 30%, then ensure that is the level that you set your stop loss. So if I'm going to set my stop loss at minus $30 level, because that is the risk that I'm willing to risk, then it means that I cannot even use a 0.1. Okay, I cannot even use a 0.1 lot size in this account, because depending again on the pair that you're trading, okay, depending on the pair that you're trading, because a pair like gold, if you use 0.1, then it means you need to set what? 30 pips stop loss, so that if that pip stop loss using a 0.1, it's equitable to 30 pips. Okay, but if you are trading the non, especially the miners, maybe you are trading a UDJPY, then you can use 0.1 because it is not volatile. Okay, and you can set a stop loss of 30 pips. Actually, even 30 pips is bigger stop loss when you're trading a UDJPY. Okay, so if you're trading, let's say gold, because I know most of you love trading gold, then using a 0.10, you need to set a 30 pips stop loss. Okay, so if you know that your strategy setting a 30 pips stop loss, it's very minimal or very risky, then you want to reduce probably your lot size to 0.05 and maybe do a 50 pips stop loss. Okay, so when you do a 50 pips stop loss using a 0.05, then you'll be risking, if your stop loss is hit, then you'll only lose $25. Okay, you'll only lose $25, right? Right? So you can see the aspect of risk management. So the higher the risk, then the higher the losses. I don't want you to focus mostly on profits, because we tend to focus on profits and forget on losses, because we said anything can happen in the market. So you want to look at the both sides of the coin. Okay, what if the trade goes against me? How much will I lose? How will this impact my trading? How will it impact my trading? How will it impact my psychology, right? Because if you keep making losses, if you keep over leveraging or over trading and you keep making losses, then you will end up being discouraged along the way. You'll blow accounts, you lose money, and it will affect you great deal psychologically. Then position sizing, once you know this parameter, then this will guide you in setting the stop loss. And then we come to the aspect of risk to reward ratio. Okay, how do you set your take profit, or where do you set your take profit? And this is guided again by the risk to reward ratio. Okay, this is guided by the risk to reward ratio, right? So when we have the risk to reward ratio, the best risk to reward ratio is 1:3. 1:3, this is the best risk to reward ratio, meaning that you are risking $1 to make $3. Okay, you are risking $1 to make $3. So let's say you have like a series of 10 trades, and in those 10 trades, you have 6 losing trades, and you are risking $10. So if you are risking $10, it means that you are targeting $30, right? The risk reward ratio of 1:3. So if you have, using this example, if you have 6 losing trades, then it means you have lost 6 times $10, which is $60. Okay. If you have, then it means that the other trades that are remaining out of 10 trades, the 4 trades are winning trades. So if you have 4 winning trades, and when you win the trades, it hits the take profit, that is 30%, $30, then 4 times $30, that gives you $120. Okay, so you incurred a loss of $60 and made a profit of $120. So at the end of the day, you are plus $60 in profit. Okay, because of the aspect of the risk to reward ratio. What if you could have used a risk to reward ratio of 1:1? Then it means at the end of the day, you'll be in a loss. If you use a risk reward ratio of 1:2 in this scenario, it means you'll be there around the break-even point, okay? Either with slight profits or at break-even point. But if you use a risk reward ratio of 1:3, so in this scenario, what I want to emphasize is that you can be a losing trader, or not a losing trader, but majority of your trades can be losing trades. But because of the aspect of risk, you are reducing your risk and your target is high, that is the risk to reward ratio, then at the end of the day, you are profitable. Because basically, when you go to when you tell someone that today you traded 10 trades, and out of the 10 trades, 6 trades were in loss and 4 trades were in profits, then at the end of the month, I will register that you are a losing trader. If I don't know about the risk to reward ratio, that is the risk to reward ratio. So at the end of the day, basically, merely, generally, I'll take you, or I regard you to be a losing trader, because you are losing 60% and winning 40%. So you are doing nothing. So, but at the end of the day, because of the risk to reward ratio, you find that now you are profitable. You have $60. You lost 6 trades and you had the minimal risk. So the loss was minimal as well. But you won 4 trades. The target or the reward was high. And the reason why you had huge profits. And now, at the end of the day, $120 minus $60, you are $60 in profit. So that is the main difference. Risk to reward ratio, it's very important. Okay, it's very important. Another thing where we go wrong in terms of trading is diversification. When I talk about diversification, this is where you find traders opening so many positions at a go, and these positions are probably correlated. So let's say you'll find, I'll give an example of 2 traders. So trader 1 opens a GBP USD. He has a GBP USD trade. He has a Euro USD trade and maybe a gold trade, right? Let's say they're all doing well. They're all doing well. And then we have a trader 2 who has a GU trade. He has a AUD JPY trade, and he has what? Euro card trade. Okay, a Euro card trade. So with this trader has over-risked so much in terms of the USD, because every currency pair here has USD. What happens if all of a sudden you hear there is another Israel-Gaza attack? So something happens and it affects the USD. Let's say something happens and affects the USD. Something bad happens maybe in the US and the USD is affected negatively. So it means all these trades will be affected. All these trades will be affected and they will all be in losses. Okay. But look at this trader number 2. He has a GBP USD, he has a AUD JPY and EuroCAD trade running at the same time. So in case we have negative news for USD, then it is only the first trade GBP USD that will be affected. So the other trades can be used to cushion the loss that this trader incurred here. Okay. So this is what I'm calling diversification, guys. If you want to open many trades or many positions, ensure that you do not over invest in one currency. This is over investing in one currency, because every trade here has USD. But this is the best way to do diversification. Okay, that is the best way to do diversification. If as a beginner you cannot be disciplined enough to take one trade at a time, then ensure you do what? Diversification. When you are buying GBP USD, then you can't have a Euro USD trade, and maybe you can't have a gold trade running at the same time. Okay, that is if especially for the beginners. Okay, especially for the beginners, because you find that those that have been in the game for long, they know these aspects of risk management. Okay, so even if I take maybe these trades, the 3 of them, then I know how I'm going to do my risk. I'm going to lower my risk because I know this is over investing in one currency. So I'm going to lower my risk to the lowest risk possible, depending on what I am willing to lose. Okay, because another key thing that makes us fail in Forex trading is trading with money that is tied somewhere else. When I say trading with money that is tied somewhere else, this is where you come, you have some cash. I'll give a typical example of what I used to do in the beginning. I used to work somewhere in a bank, and because by that time I was in a very junior level, the money that I used to earn was not enough to meet my needs. So what I did, bankers usually get paid around the 20, 21 to 24. So once I get my salary, I could take my salary and deposit in the trading account. So I want to at least trade for the few days remaining before I maybe pay the rent on date 5, so that maybe this money can give me some more money so that I can now be able to meet my needs. And you know what happens? You tend now to trade either with fear, losing to lose whatever you have. So you can see opportunities, but you don't take them. So that is fear. Or you'll tend to over trade that account so that by the time it's 15th or the 5th to pay rent, that money, you'll have gotten some rent out of that money. So you'll tend to overtrade. Okay, so when you overtrade, the more you overtrade, the higher the chances that you will incur losses. So you become greedy. Okay, you become greedy. You start using high lot sizes or huge lot sizes, abnormal lot sizes. And at the end of the day, I could find myself losing, being in a stressful condition. I had a salary, but it's all gone in the name of trying to baptize that salary so that it can give me more money. So the reason why I'll caution you again, I don't want you to go through the mistakes that I went through. The reason I'm here to help you your journey to be seamless. Maybe this is your first month you're trading Forex. During our time when you are learning Forex, we didn't have such kind of people to tell us this, that, and that. Okay, we were hyped by those huge Excel sheets. There are Excel sheets that go online. They tell you that if you deposit $100 and you compound in 90 days, you're going to make $100,000. Okay, so those were our times. They could not even help us to in terms of risk management, because such kind of an Excel sheet will actually see you over trading so that you can realize those goals in a shorter duration. So to avoid that, the reason why whatever you are trading with or whatever money you come to trade with in Forex, ensure this is the money that it remains after you sort out all your things. You pay your rent, you do shopping in your house. So all things are at par. Then whatever remains, deposit in your trading account and trade. Do not make the mistake of maybe going to the mistake of going to to take maybe a loan and start trading. Okay, so it will affect you psychologically. You trade with fear or greed. Okay, because you don't want to lose that amount. You don't know what you'll pay the loan with, and greed because you want to hit the targets and pay the monthly installment that you're supposed to pay. And at the end of the day, it will end not good for you. So ensure that the money you bring into Forex trading is money that you are willing to lose. In case bad things or the worst happens, then it does not affect your way of life. It does not affect the way of your living. Your house will not be closed because you haven't paid rent. You won't sleep angry because you don't have food to eat. Okay, so don't trade when you have that money tied somewhere else. Ensure it's free money, so that you can have a peace of mind. Okay, that will give you a peace of mind, meaning that you'll trade peacefully with a good, correct emotions. Okay, correct emotions or correct mindset, and that will propel your journey to success. Then the other thing is using the leverage wisely. We tend to misuse the aspect of the leverage. You find that most of the traders, they have gone to use let's say international brokers, because maybe they provide high leverage, and that again comes with a risk. I once used an international broker. I traded well. I made money. But when it came to withdrawing, they refused with my money. So I had made $500. So that does not tell me it doesn't beat logic going all the way to Australia following $500. But if I was trading with a broker here in Kenya who is licensed by CMA, and such kind of a scenario happens, I just pay 100 bob and I am at the CMA office. Okay, I report. So again, ensure that you're trading with a broker that is regulated in Kenya. And the reason we are here, scope market regulated by CMA, right? Meaning that your funds are secure with us. So the leverage is a double-edged sword. Like we saw in the beginners class, we saw how leverage can either make you lose a lot of money, how it can expose you in terms of risk, because the higher the leverage, the higher the lot sizes that you can be able to open, or the position size. It gives you the advantage of using huge lot sizes. Okay, so if you're not careful, then you find that the leverage can harm you, especially when you're in the beginner's level, when you're trying to learn this thing, align yourself accordingly. So always ensure you use leverage wisely. In Kenya, CMA allows us to give up to 1:400 leverage. That is the maximum we are allowed in Kenya. But that does not mean you need to use the maximum. You can use 1:200. You can use 1:100. Okay. If you find that you're struggling with position sizing, then the best thing is to ask us to lower your leverage, so that this low leverage can always tame you in terms of position sizing. Because the lower the leverage is, then that means you cannot be able to open huge positions. So the higher the leverage, the huge position you can be able to open. The lower the leverage, the lower or the less positions that you can be able to open. So always ensure you use leverage wisely, depending on the amount that you are willing to lose. The reason I'm saying that, we are all able differently. There is a person who is comfortable losing $1,000. There is someone who is comfortable losing maybe, or risking. Let me use the word risking. There is someone who is comfortable risking $1,000. There is someone who is comfortable risking maybe $10. There is someone else who is comfortable even risking $10,000, because you are all able differently. So identify your risk tolerance. Okay, identify your risk tolerance or your risk appetite, so that you can be able to align yourself with the correct leverage, which will also guide you in terms of position sizing. Okay, position sizing. But again, no matter the leverage you are using, the rule of thumb, don't risk more than 1 to 3% of your account balance per trade. Okay, so keep emotions in check. At times we tend to trade with emotions. Okay, and we tend to lose money because you find maybe you have traded, you have done the first trade, the second trade, you are in losses, you have incurred losses, emotions eat you, you start now doing revenge trading or chasing after losses, okay? And what happens at the end of the day, you will be in deep losses, okay? So because now your emotions will be interrupted, you won't have that peace of mind maybe to analyze the market effectively, to get those high probability setups. So you tend to trade randomly because maybe you are sad or you are hungry with the market and you want to recover your money. So at the end of the day, you'll even lose more. So when you find yourself in such instances, when your emotions are not at par, the best thing you can do, or the justice that you can do for yourself, because you love your money that you have deposited to trade, then stop trading and fine-tune your emotions. Only trade when you have the best or the right emotions, okay? Only trade when your emotions or when your mind is at par. When you don't have things that are disturbing you psychologically, okay? When your mind is at peace, that is the best time that you need to engage in trading. And that is the best time that you can make profits in trading. Don't force trades. Don't trade if you're not at a position to trade, okay? If your mind is not right at that moment, don't trade. We met the market here. The market is not going anywhere. If you don't trade today, you'll trade tomorrow. If you don't trade this week, then you'll trade next week. Okay, so be disciplined, always keep your emotions in check. If your emotions are okay, trade. If you feel that your emotions are not okay, then avoid trading that day or that hour, maybe until maybe when your emotions come back at par. Then continuous learning. We have been giving you education from basics to advanced, right? So that does not mean it's the end of the road. Once you finish the education that now you are a pro. No, what you need to do is continuous learning. And continuous learning is not even basically taking through the Forex education or learning more those strategies or something. Yes, it can be that dimension, but also back testing. It's a way of continuous learning. You want to study the previous chart patterns, the previous data of the market, so as now from that you are able to see, probably, who knows, you can maybe identify something unique with the market, maybe something unique that the market does maybe at a particular hour, okay, through backtesting. And that can be your breakthrough. That can be your edge, okay? That can be your edge. That can be your strategy. You can use it effectively to make money comfortably, right? So always ensure that you interact with the charts. The big mistake we do as Forex traders, you take the classes, you are active like for a month, and then you go offline like 2 months, and you are coming now in again. When you come in, you'll come in as a beginner, very fresh. You'll have forgotten some things. You'll have forgotten maybe to catch up with the movements of the market. Because what I tell my student is that even if you're not trading that day, ensure that you open the charts, try to analyze the chart, see how the market moved, okay? Try to see how you could have traded, the positions that you could have taken, okay? That makes your mind in motion with the market, in sync with the market, okay? So don't go offline again like maybe 2 months, 1 month, you have never looked at the charts, and now you want to come back in again. Yes, you can begin, but you will begin as a beginner. You will start from scratch. So to avoid that, ensure that you are consistent. If you are not trading, just open those charts, analyze them, and try to see various chart patterns and how they move. Appreciate the price action. So that will keep your mind always in sync with the market. Then the other thing that you need to do is to monitor and adjust. Monitor what is working, what is not working, and look for a way that you can be able to improve or adjust. Continuous improvement will lead you to success. But if you are static, you don't want to change, you don't want to adjust, you don't want even to measure your performance, then at the end of the day, you'll also be static, or you'll even deteriorate. You'll even be worse than where you are. Okay, so ensure that you monitor and you adjust these strategies. Okay, ensure that you monitor and you adjust these strategies. If a risk to reward ratio of 1:2 is not working for you, then why not try to adjust 1:3? Okay, if a certain strategy is not working for you, or if maybe the risk 3% risk is not working for you, why don't you adjust maybe and do 2 or 1%? Okay, so don't be static, always be dynamic. Okay, move with the market, move with the market. When you have high volatility, you want to lower your risk because you know there can be high chances that you lose money, so you want to lower your risk. Okay, so another key aspect is the trading plan. When you talk about the trading plan, this is like a constitution that guides you. They always say that failure to plan is a plan to fail. So if you're engaging in Forex trading, you don't have a plan, then it means that your plan is to fail. The reason why you need to have a trading plan. And a trading plan, it helps you know what to do, why, when, and how you should do it. Okay, so these are some of the things that needs to be in your trading plan. So every trader needs to be to have a trading plan. When you are doing business, before you start a business, you need to sit down and draw a business plan so that it guides you through the startup all the way until the successful of that business. Okay, along the way you keep adjusting the business plan depending on how it is responding to the economy. The same case in Forex trading. This trading plan is not static. The reason we are saying that you have to review it and adapt. You have to keep reviewing it and adapt. You take what is working, you capitalize on it, and you take what is not working and you drop it away. Right? So in your trading plan, this is why you need to have your trading goals and objective. And I know if I asked you to type in the chat, maybe probably what's your trading goal, I know most of you, 90% will say that their trading goal is to attain financial freedom or to make money, which is not bad. That was my goal when I came to Forex as well. But I later on realized that that was not the best goal. That is not how to set good goals in Forex. So the reason why I had to fine tune my goal and say that my goal, number one goal, is to learn how to be a successful trader. So if you learn how to be a successful trader, then it means you are like magnet to them, to money, because money will follow you. If you're a successful trader, money will then follow you. Okay, so what if you also consider the same? From today henceforth, don't look at money being the primary thing that you're in Forex trading. Instead, the primary goal should be learning how to trade Forex to become a successful trader. So once you become a successful trader, then it means money will follow you. Why can you not adapt such kind of a goal? It's a smart goal, right? Then trading strategy. You need to define your trading strategy in your trading plan such that you are able to know which strategy, such that you are able to know with your strategy, when does it align so that you can trigger the market? How, using your strategy, how does it help you in terms of getting entries and exits? Okay, so then you also need to define your trading hours. You find that there are those traders that maybe trade in different hours depending again on their strategies. So which hours are favorable? Which sessions are favorable to you? Is it the Asian session? Is it the New York session? Is it the London session? So you need to identify the ones that are favorable. Okay, the ones that your trade strategy is favorable to them. Then you need to keep a trading journal, and we shall talk about the trading journal as we come to an end, just in a few minutes. Just give me a few minutes of your time because this is very important. Emotions control, we have talked about emotions. You need to have a contingent plan, okay? What if this setup does not align? So what should I do? So you need to have those plans. You look at the both sides of the coin. Capital preservations. What measures are you doing to preserve your capital? I gave you one of the best measures is ensure you are trading with a 1 to 3% risk for every of your account balance for every trade. Also, you can use the aspect of risk to reward ratio 1:3. That will keep you in the game for long. It will help you preserve your capital. Then again, you need to do what we call performance evaluation. They say there is a saying that says whatever is not measured is never attained. So if you're not evaluating your performance, then higher chances is that you might not even be up to par in terms of performance. You'll never know whether you are doing well or you are doing poorly or you are doing bad, because you want to know whether you are doing bad so that you can look for areas to improve. Okay, you rectify that so that you can have best results. If you are doing well, then you want to maintain and even enhance whatever you are doing so that you can have even more success. Okay, so always ensure that you have a way of evaluating performance in your trading plan. Maybe it can be weekly, it can be monthly, but weekly is the best. Okay, weekly is the best because you have what the trades you have journaled, the trades that you have done the entire of that week, and then now during the weekend when the market is closed, that is the time we want to do what? Evaluations. Okay, you want to evaluate yourself, right? This is not like employment where you are evaluated maybe quarterly or monthly. No, this you want to do weekly. Weekly evaluation is the best. How did you fare this week? How was last week? Have you improved? This week, last week, your win rate was 3%. This week, your win rate is 4%. So that means there is an improvement. Okay. If there is no improvement, then it raises question mark that you need to revisit whatever you are doing. It's not working. You need to revisit it, fine tune it so that it can work. But the funny thing is, most of the traders find this thing to be difficult. They say it's time consuming. But remember, you have to put efforts in order to realize success. There is nothing that comes in a silver plate. Okay, you have to go for it. You have to go for it. You have to go for it. You have to put in the efforts. So put in those efforts and prepare yourself a nice trading journal, a nice trading plan. Okay, you have a nice trading plan. You create a plan. How you want to see yourself maybe in the next 5 years. What will you do so that you can attain those levels when 5 years comes down the line, you have achieved whatever goals you had. Okay, you need a plan. Okay, so always education and improvement, always we have said that is not negotiable. You keep on improving your knowledge, you keep on attending to webinars, you keep on attending maybe to seminars, anything that can help you enhance your forex trading journey. Those always ensure, if you get time, always ensure that you attend, because it will help improve your education. Okay, now that you have this knowledge, you know where to look, you know how to begin from beginners to advanced. You can now comfortably go to a YouTube channel and search and learn systematically, because now you know how it goes. You know the blueprints. I've given you the blueprints, so you can be able to enhance your knowledge. Okay, so then you need to review and adapt. Okay, you need to review your trading plan and adapt. You remove whatever is not working and you capitalize on what is working. And now we have the trading journal. When you talk about the trading journal, this is where you journal down your trades. Like maybe you say the trades that you took that day, the time, the stop loss, the take profits, all those parameters, so that it can help you in terms of evaluating your performance. It can help you in terms of identifying patterns, making improvements in your trading strategy. Okay, and these are the things that you need to have in your trading plans. You need to have your trading details, so you capture the day, the date, the pair, the stop loss, the entry price, all those things. You can because of time, you can just go to the previous video again I did for the master's class. in that video, in that webinar, I showed how to do, how to come up with a trading journal so that it can help you journal your trades, okay? Because if you are trading without journaling your trades, then how will you do the performance? What will be the point of reference when you're doing a performance evaluation? So the reason why you need to have the trading plan with you, or the trading journal with you, so that when you are reviewing, you can see, maybe for instance, being a beginner, you are like trading using every strategy. You are using every strategy that you have been taught. You want to see which one gives you an edge. How will you know if you're not journaling? So in your journal, part of the section of your journal is the strategy. You want to know which strategy you use to take that trade, so that you look at the strategies that are giving you more profits and the strategies that are giving you more or bigger losses. So you want to do away with the strategies that are giving you losses, bigger losses, and capitalize on the strategy that is giving you more wins. Okay, that only you can be able to identify through journaling. Okay, so in journaling, it's very important. Ensure that you have a trading journal. Go and watch that previous webinar. Ensure that you prepare or you make yourself a very nice trading journal so that you can be journaling your trades. We are at the beginning of November. Tell yourself that in this November, I want now to change my game. I will not be trading aimlessly. I want to keep a record of my trades. If we come to the real world of business, to the business world, those businesses that succeed, they are the businesses that journal their activities. So if you buy in stock, they journal. When they sell, they write, I have sold this at this price that day. So at the end of the day, they are able now to see the stock that came in and what came out. So they are able to know whether they are in profit or in losses. Those are the business that succeeds. But when you do a business without journaling, without putting in the records, then in terms of performance evaluation, most of the time those businesses will tend to fail because they have no point of reference to do the evaluation, to do the performance. Okay, so you have to account for each and every trade that you take. Again, most of the traders and beginners, they say that, especially beginners, they say that having a trading journal or journaling your trades is a lot of work. But like I said, you have to put in that effort so that you can have an edge in the market. These are the things that we did not do in our time. These are the things that delayed our progress during those times. We could be far away if we started with the right information. But lucky you that you are able to get this information at your level, beginning level. Okay, some of us, we were being taught by the market these things. Unaingia, you blow the account, and then now you come back to you sit down to reflect what happened. Okay, but for you, it's different. You have this information free of charge. Okay, so some of the common mistakes that we make, or some of the common mistakes that you make, guys, it's just like a summary of what I've just talked about. So lack of education and preparation, you find that you are trading without education. So it's like you're gambling. Basically, not like you're gambling, but you're gambling when you're trading without the know-how of how to trade. But thanks to you that have spared time to attend to the webinars that we have been doing, because now you have been trying to improve your education. Then we have over leveraging. Okay, we have talked about over leveraging. So the rule of thumb, use leverage wisely. Don't over leverage. Okay, don't over leverage. If you find you're struggling with over leveraging, just message your account manager or call your account manager. Tell him or her to reduce your leverage, that you want your account to be reduced even to a leverage of 1:30 until you become disciplined, right? Until you become disciplined. Then lack of a trading plan, over trading, those are just the mistakes. What we have just said, those is just a summary of what you have said. Failure to adapt to market conditions. When we have high volatility, you don't want to lower the risk. You still want to use the 3%, the highest risk possible. So because of the volatility, again, you might end up losing. So you want to adapt to market conditions. Emotional trading, we have talked about it. Another mistake that people do is ignore fundamentals, okay? You ignore fundamentals, or what you're calling neglect news and events. So when you are doing your analysis, you'll find that your setup is 100% okay. It has confirmed everything 100%. What now you need to do is to execute the trade. But at times you can execute the trade without knowing, without not checking the fundamentals, and maybe we have some news in the next 5 minutes, and all of a sudden the trade goes wayward. It goes against you, and now you start doubting whether these strategies works or not. Because when we have news, the market is very volatile. At times it cannot respect the strategies because it moves in the direction depending on where the data has come from. Okay, so don't be so happy when you are in a trade, when you execute a trade, and maybe in the next 5 minutes there is news and it goes in your way and hits your TP. Don't be so happy about that. Okay, if you had not looked at the fundamentals and maybe tried to align the fundamentals with your strategy, and then the trade goes your way and hits your TP, then don't be so happy about that. But instead be happy when you have a setup and you have factored the fundamentals, and the setup on the fundamentals respect your setup, because you had already known that there are some fundamentals, and you have analyzed those fundamentals, and you have aligned yourself accordingly. Then that is the time that you can be happy. So always ensure, once you do your technical analysis, okay, before you execute the trade, just check the fundamentals. Check the fundamentals. The reason why, those who are in the Telegram group, I usually start by sharing the fundamentals of the day, so that I can make you aware that you're expecting this and this today. So that when you are doing your analysis, when you're aligning yourself, you now align yourself as well according to the fundamentals. Then the other thing I talked about chasing losses. That is revenge trading. Don't do revenge trading. If you make losses, have a target. Maybe say, if I lose 1% of my account balance today, then I'll stop trading until tomorrow. Okay, when you have such kind of rules written down in your trading plan, then it will help you not to overtrade. It will help you not to chase after losses. Then have patience. This is a game of patience. Okay, if you're impatient, learn how to be patient. Forex will teach you to be patient, but don't be taught by Forex, because when Forex teaches you how to be patient, then you'll have incurred a substantial amount of loss. So instead, train yourself to be patient. Train yourself to be patient enough to wait for the strategies to align 100% before buying or selling. Okay, patient to wait for your strategies to align accordingly before buying or selling. Then again, overconfidence. When you find yourself like you have done 5 consecutive wins, higher chances that you might be overconfidence. And the moment now overconfidence eats you, now you'll want to even trade more, or you might ignore some aspect when you're doing your analysis, and you end up, the next trades that comes, you end up making losses. You even wipe out the profit that you had made, and now you start chasing after losses, and everything goes wayward. Don't ignore demo trading. The demo is your friend. No matter the level you are, there are things that you need to test in your demo account. Okay, once you have reached your trading targets, the next, if you see setups and you feel like trading, why not place them in demo account, right? Then have failure to set realistic expectations will make you not to be successful. It's a common mistake. You are a beginner and you want to make 150 pips on a daily basis. It's next to impossible. It's next to impossible, okay? So begin with realistic goals. As a beginner, maybe you want 20 pips, 30 pips on a daily basis. That is very much achievable, easily achievable. So you keep improving depending on your level of expertise, okay? You keep improving until now you'll find yourself in that level that you can even target 200 pips in a day, which is possible, okay? So have SMART goals: measurable, specific, measurable, attainable, realistic, and timely. All right? So that's it. I believe you took my advice well. Let it not enter here and exit here. but let it enter here and remain here. Okay, always have it when you're trading. Write those things down, put them in paper. When you're trading, open that paper, let it face you so that you see those things, and that's how you teach yourself to be disciplined, to avoid those mistakes. You will conduct a live training now. When you're in the questions, I'm looking at the questions, and before I answer the questions, probably you don't have a scope trading account. I'm just sharing the links. Okay, so I'm sharing the links in the chat so that you can open an account, as well as the link to the channel, our Telegram channel, whereby we share trading ideas. I help you identify possible trading scenarios. Okay, so I shared 2 links. One for opening an account. Click that link, open an account, a demo account and a live account, because you're gonna be trading. Right now you have done from masters, from beginners to masters, so is the high level, is the high time to advance. So we shall have a live analysis, live trading for the NFP. So ensure you have an account, scope market account, funded, and be ready. Okay, so I also shared the Telegram channel, so ensure